been a roller coaster ride for oil markets, with prices rising on news that OPEC oil production has fallen by more than 1 million barrels per day so far. A clear message from the global cartel that its move to cut supply is impacting prices. Late last year, OPEC President Mohammed bin Saleh Al Sadeh was confident the move would help rebalance markets.
This is a major step forward, and we, with my colleagues, we think that it is a historic moment to come to this agreement, which will definitely help in rebalancing the market, and it will help reducing the stock overhang.
Fast track to 2017, and Saudi Arabia's energy minister is even more convinced oil markets are back on track.
I am satisfied, I am optimistic. As I've said a number of times, the markets are on their way to rebalancing. It's just happening faster than it would have without the declaration of cooperation that we signed with non-OPEC countries.
But many investors are still not convinced the cut will rebalance markets.
According to the IEA and other independent observers of the oil industry, the production cuts agreed in December of 2016 have probably got to go further than just 6 months if the entire surplus is to be whittled away.
The Organization of the Petroleum Exporting Countries says that so far it's achieved 82% compliance of its promised cuts. But global investors are also monitoring a rise in the number of active oil tankers around the world, suggesting there's still more supply lurking than international demand.
You would think, being OPEC and being Saudi Arabia specifically, they've taken 500,000 barrels a day off the market and boosted prices by around $5. You would think that rather than putting that oil back onto the market and accepting a lower price for it, they would keep that oil off. We've had indications from them that they're not going to do that, which seems somewhat counterintuitive. And so from the rhetoric that we've been hearing from OPEC and specifically Saudi Arabia, it seems that these production cuts are going to be a relatively short period of time.
Investors are trying to position themselves on where oil markets will go this year, especially ahead of the U.S. Federal Reserve hinting at policy tightening in the United States.
I think that looking at the oil market in the context of the global and US in particular interest rate environment is very, very important. A very good question, because it's not simply about demand and supply. And here's why. When the IEA made its forecast that there were something like 66 days of inventory, excess inventory out there, that at prevailing oil prices equated to about $140 billion of inventory to be financed. Now, of course, when interest rates are at zero, or indeed in many locations negative, that represents an extremely attractive investment. A hard asset like oil, all that inventory, wowee, who wouldn't? So speculators have piled in. But as interest rates start to rise, the cost of financing that inventory, albeit that the inventory is going to be reduced, is likely to go up.
If the U.S. Fed follows through with more rate hikes, that will further strengthen the dollar, making oil more expensive and reducing appetite for the so-called black gold. This year, the challenge for OPEC is not only to rebalance supply and demand, but also ensure its accuracy on rising demand from countries like India, China, and the U.S. stays on track. Maryam Behmard for CGTN.